Hello, hello. Welcome to CashFlow Hacks Podcast. I'm your host, Chris, and I'm with my co-host, Stephanie.
Hello, hello. I'm so happy to be here with Chris, who is live from where, Chris?
I am calling in live from Cancun, Mexico.
I'm so jealous. But I'm excited to be here with her and everyone else who's ready to make more, save more, and live more now.
Well, you are so in the right place. Every week, Stephanie and I are going to be sharing strategies that your financial advisor doesn't want you to know. And why is that? You've heard it before, because the less you know, the more they make. And we're here because we want to help you flip that.
Absolutely right. So this week, we're going to continue talking about the 5 enemies of wealth.
Well, last week we talked about, let me just give you a reminder of what those 5 wealth destroyers are, or those 5 enemies of wealth. They are inflation, market fluctuation, devastation, litigation, and taxation. And today we're going to go over devastation and litigation. And then next week we're going to talk about taxation. If you missed last week's podcast for the first 2 enemies of wealth, you're just going to have to go back and listen.
Right. And it was a lot of valuable information that you shared last week. So if you missed it, definitely go back and listen. Today, we're going to get started with devastation. What do you mean exactly when you say devastation is an enemy of wealth, Chris?
Well, when you hear devastation, what comes to your mind first? But most people, when we're talking about devastation, they think we're immediately going to start talking about life insurance. But nobody wants to talk about life insurance. Why is that?
Because for most people, it's boring.
They don't want to know about it. And they don't want to talk about death, the possibility of dying. But,
right.
Listening to Susie Orman, she always says, if anyone depends on your income, anybody, you need to have life insurance. Why? What's the reason for that? If something were to happen to you, and what would happen to your family? Having life insurance could provide financial security. It could help pay off debts. It could help pay off your house. It could even pay for living expenses, which I'll talk about in a little bit. But the other thing is that it can help pay for medical expenses. And finally, and we know nothing could replace you, but life insurance could replace your income for your loved ones. Life insurance, it can also be used for leaving a legacy, which many of our clients love to be able to leave a legacy for their family and create tax-free. Maybe you've heard of that, maybe you haven't, but that actually is a really, really, really big thing for life insurance when it comes to for our clients. Also, when you have life insurance, it helps build your estate, and you could have liquid funds that would pay for the taxes, and also like a business buyout. One of the big things is a lot of my clients, they definitely I know you always talk about becoming self-insured, and that's a good thing. However, most of my wealthy clients all have life insurance, and one of the biggest reasons they have the life insurance is to pay for the taxes, not the taxes, because we don't have to pay taxes on life insurance money, but the taxes when you're leaving your beneficiary money.
Estate taxes.
Estate taxes. We pay for the estate taxes. And so we want to make sure that our clients, they're fitly insured, and make sure that we can show them how to utilize life insurance as an asset.
Absolutely. And there are different types of life insurance. So I'm interested to hear more about the tax-free pensions. Can you elaborate on that for me?
Sure. This is my favorite, actually. I like the cash value permanent life insurance because if you max out the cash value, you can use this as your own bank. You can create your own tax-free pension. You can borrow from it, lend from it, take advantage of all kinds of lucrative opportunities. I actually did this myself a few years back. My neighbors were selling their home, and they were to buy another. And the contract fell out with the people that were buying their home, but they didn't want to lose the new home, so they came to me and asked me to purchase their home. Well, I didn't keep that kind of cash in my bank account, but I did have it in my life insurance policy. So I was able to take the money out of the life insurance policy and take over this house for them. And within 3 months, I was able to sell it and make over $60,000. So life insurance can, and people don't even know the things that life insurance can do. It's very cool. When we borrow money, we don't pay taxes. So in life insurance, if you cash out or withdraw the money, you will have to pay the taxes on all of the money that you've made, on all the profits. But if you take it out as a loan, no taxes. So that is one of the ways that you can create your own tax-free retirement, especially if you design it properly. It is so exciting for me. I actually call this a boy account, and that is bank on yourself. You start banking on yourself instead of the bank.
Love that.
The only problem is, the biggest problem I think that I've seen is that there are many people that have been told that they need to get this policy, this kind of policy, and they're excited about it because they want to have some kind of tax-free pension. However, if it's not designed properly, if you are not working with the right agent, then they're going to make a great big paycheck. They're going to have a big commission check, but it's not going to really work out for you. And honestly, when you read about this and you read negative comments about this policy, that's the reason why it wasn't designed in the best interest of the client. It was actually the agent made a great big commission off of it.
Mm-hmm.
So there are a lot of agents that won't even sell these type of policies because they know that when they do it and design it correctly, the commission is going to be cut by more than 75%. And a lot of people won't go for that. But the other thing I want to say about these type of policies is that they're not for everyone. Not for everyone. It doesn't matter who you are, what your friends tell you, what the agent tells you. If you cannot max fund these type of policies, do not get one. Do not get one. They will not work out for you the way that you were hoping for.
Very interesting. And you mentioned it. I just want to reiterate that this is not for everyone, because I just want to make a point of it because I've heard people talk about this. And unfortunately, the spot that they're in right now, they don't have the money to do it properly, but they get excited about it, about the ways that it can help, and they want to do it anyway. And I always tell them that, hey, if you're not setting it up properly, if you're not able to do it in the right design, like you mentioned, that it's going to hurt you in the long run, because like you said, it only helps the agent at that point. So it has to be designed properly and fully funded to work properly. And that's so important that we take into consideration, like doing it right. So even if your best friend told you how awesome it is and, you know, how it's been working for them, maybe they had enough to fully fund it in the beginning, don't do it. And don't do it without having the right agent.
Right. If you cannot max fund it, if you cannot they call it overfund it. If you cannot overfund this, then, don't do it. If you think that this might be something for you, reach out to us, because we call them our risk management specialist and our bank on yourself specialist, and we can help you. We can show you if this is something that could work for you or if it's not a good idea for you. And I know that, Stephanie, you love to talk about term insurance, and I don't dislike term insurance. I think it's definitely a good thing to talk about. So why don't you talk a little bit about term insurance?
Right, Chris. So if you cannot max fund that account, obviously we both still believe that you need to get life insurance. And so if that is not where you are right now, the next best thing is to get term insurance, right? Because you do need to have insurance. Just like you mentioned, Chris, Susie Orman says, if somebody depends on you, you need to have it. So my clients use it as a foundation of building their house. Chris made a comment about the high net worth clients that she works with, that maybe you're not there yet. You're getting there, you're on your way there, but you're not there yet. So what you should utilize is term insurance, because it is the biggest bang for your buck. You'll be able to get the most coverage for the least amount of money as you're building up your wealth. It is pure insurance, so there's no cash value savings included in this type of insurance. But I just want to give like a quick little warning. that not all term insurance is created equal. And as Chris mentioned, sometimes there's some unscrupulous agents out there, and they're going to put you in the wrong type of term so that they convince you and push you back into the other type of life insurance where they make a bigger commission check. Because with term, they make a lot less. So the three types of term that you need to know are called ART, which is annual renewable term, level, and decreasing term. So ART is a type of policy that renews every year. As you get older and less healthy, every year the premium, the amount that you pay for the insurance, is going to increase. It's going to increase to reflect if you're healthier, and a little bit older. Agents will put this in place so that as it gets more expensive, it's easier to convince you to switch over to a policy that's good for their pocketbook, but not necessarily for you. Anyway, you pay more every year, but the amount of coverage, which is what your beneficiaries would get if you pass away, would stay the same. Now, why have a policy that's not good at all? There is no such thing as a policy that's not good at all. It's just for the right circumstances, right? Like Chris said about the insurance type she was talking about. So in the beginning, the good years where you're younger and healthier, your price is lower, right? So it's cheaper. Now, if you only want something for a couple of years, this would be the way to go because it's going to stay the lowest price because you only have it for a short period of time. I see this being the most beneficial when you have a business owner that wants key portion insurance, right? You're not going to have it for that long. You don't want to take on the ending years being more expensive. The next type is decreasing term. This one is usually used in mortgages. So every year that you pay your mortgage, the amount of coverage decreases because they're just going to pay off what you haven't paid yet. So that amount decreases year after year as you're paying your mortgage payments, right? The amount that you owe is less and less. But your premium, the amount that you pay every month, is going to stay the same the whole time. I personally don't like this type because you pay the same amount for the whole time, but your coverage is going down and down. That's not really a good utilization of your money. My favorite, the one that I like, is called level term. So you're going to pay the same amount of premium for the duration of the term, and you're going to receive the same amount of coverage for the whole time as well. So in my opinion, if you're paying for it, get the total amount, right? Pay off the mortgage and keep the rest for other expenses your family's surely going to have. For me, it makes the most sense.
I think I think, Stephanie, I think when you saying that, I think the level term is the best also because you've probably heard, I know probably everybody has heard insurance agents that are calling to talk to you about mortgage insurance. And like you said, it's like you're paying the same amount for all these years, but every year the death benefit is going down because the coverage, it's less and less coverage because the mortgage is going down. So I have to agree with you on that one. If anybody asks you to get mortgage insurance, do some research on that or give us a call. We can help you with that too.
Right. Yeah, because if you're going to pay the same amount, have the same amount of coverage, right? And then just use the difference for other things. Yeah, exactly. One other thing I did want to mention that a lot of people say is like, oh, well, term ends. Yes, term does end. So you want to think about like the length of time to get the term because there are different options available from 10-year term to 35-year term, right? You could have a different amount of time. And so what I do is I always devise a plan with my clients to get the amount of term or the length of time that it will take for them to become self-insured, like you mentioned before. So what do I mean by that? I'll give you an example. Let's say you get $500,000 in coverage and working together, it's going to take you, say, 20 years to save $500,000. Well, then you'd need a 20-year term. After that, you have enough in case of emergency, quote unquote, money. And then life insurance is used for what you talk about, Chris, legacy, right? Or tax strategies. But it's no longer just used for in case you pass away, your family needs to be able to survive because you already have that money. Does that make sense?
Yeah, I hear what you're saying. I mean, there's a lot of people out there that talk about being self-insured, but honestly, I think that everybody needs insurance, especially even if you have enough money to self-insure. It's like, why would you want to use the money that you work really hard for to have insurance whenever you could meet the cost of insurance is so inexpensive. when it comes to life insurance. And I think everybody needs to have life insurance. It's just a matter of what are we using it for.
Right. So that's what I'm saying, is that once you have enough that you're self-insured, then insurance should be used for legacy planning.
Right.
For other reasons, not coverage.
Right.
So then we can talk about you having enough money to do that maxed out cash value insurance plan.
Right. Yep. The only thing I haven't heard you talk about, Stephanie, is term with living benefits. And I actually love this type of insurance. This is our favorite. This is what we sell all the time. Actually, the only term insurance we sell has living benefits. Mm-hmm. And the reason for that is, they have life insurance, but most life insurance used to be only used for when you die. You can only use it when you die. And now you can actually get life insurance that you can use while you're alive. And I have a good example of this. One of my clients, this was when I first started working, his father-in-law purchased $1 million policy on him. He had just got married to his daughter, and he wanted to make sure that if anything happened to him, his daughter would be taken care of. And he probably only had the policy for about 6 months. And he found out that he had throat cancer, which was very strange for a young person to find out they had throat cancer. And they told him that it was stage 4. Like it was a really aggressive type cancer, and that they said there was nothing that they could do for him. They ended up, when this happened and he was diagnosed as being terminally ill, the insurance company wrote a check to them for 90% of that $1 million policy. So he had a $900,000 policy. $900,000 check. He was able to do whatever he wanted to do. Some people use that to see if there's any other way, any other place, any other country that could help them. And some use it to just be able to go on that one last hurrah and then be able to leave some money for their family. But this kid, I call him a kid because he was young. He was really young. Yeah. He went back to his family in India, and they were able to cure his cancer, which to me, that should say something to you about the United States. And
that's healthcare. Yeah.
It's scary. It's sad to me. We live in the United States. It's supposed to be the best place to be in the world, and yet it seems like our government, our financial, we want to keep people sick and broke. And I won't even go into that. That's a whole nother topic. But it's like he went there. He was cured. He ended up coming back to the States. He calls me to see if he could get more life insurance. And I was just getting started. And as far as I knew, he was no longer insurable because he already received that much. Mm-hmm. He received that much money from a life insurance company. So if he didn't have those living benefits, he would not probably be here.
Yeah. That's awful that it happened to him, but wow, what an incredible comeback that he had. And the ability to get access to that money, that's life-changing. Yes. I agree. It's a great reason to have living benefits, because medical bills definitely are destroyers of wealth. But to that point, my uncle passed away from cancer. He had clavicle cancer, and when he was dying, my aunt, she was fighting with the insurance companies that just, not life insurance, but their health insurance. And they're like, oh, we're not going to pay for this. We're not going to pay for that. And so there were a lot of out-of-pocket costs. And had she had a life insurance policy with living benefits at the time, she would have been able to pull out from that and do things that health insurance companies won't cover. Because that's a whole different conversation we can have as well. But yeah, it's not just about where he went, because like you said, he was able to go to India, which is awesome. But even if there are things that you can do in this country, if your health insurance company won't approve it, if you don't have access to that kind of cash, it's still awful, right? So that's amazing. Thank you for sharing that story with us. So now let's turn to litigation. Can you expand a little bit more on how litigation can destroy your wealth? And is there anything that we can do in this instance to protect ourselves?
Absolutely. It's not a secret that we live in an increasingly litigious society. I live in California, and I think that state is the most, people sue you for anything.
And we're too happy.
And honestly, that really is why estate planning is so important. Our future depends on the plans that we make today. And one of the things that I've heard people say, and it's a really big misconception, is that they think they don't have enough things to have an estate plan. But the truth is, if you have possessions, if you have anything, that is your estate. You need to have a plan for it. If you don't have a plan for it, guess who gets to have a plan for it? The state. And we don't want to have if we get in a law that sues us, we want to make sure that our assets are protected and keep what we work for and not let our families have to take up the slack for us. So the other thing is proper estate planning will enable you to manage your investments more. And a lot of people think that estate planning is super costly, but really, when you look at it, yes, there are certain types of estate planning that can be very expensive. But even if you have a small, there are ways to protect yourself and protect your family without it being so costly. Because in the long run, if you don't have it done, it's going to cost your family. So
more expensive not to have it, right?
Exactly. The other thing is that a lot of people think you need to have, I have a will. I have a lot of people that come to me and say, oh, I have a will, and we update it all the time. We keep track of it. And it's like, oh my goodness, having a will, can actually be very, very expensive because, for one thing, people can contest it and end up in lawsuits. And it ends up being very expensive to just have a will. But you don't need to just have a will. You need to have healthcare directives. You need to have a proper estate's going to have all these things. You're going to have your power of attorney for your finances, for your healthcare. And one of the best ways, I think, is to have a trust. A trust can help with that so much.
Very true. Let's take a pause for a second and explain some of the concepts, some of these terms, because it might be the first time people have heard of them. So you said that a proper estate plan includes, remind me one more time?
You need to have a will. You need to have a living will. Basically, a living will is very similar to healthcare directive and a power of attorney for your finances and for your health. A trust. There's not just any kind of trust, though. So I'll tell you about that a little bit.
Okay, so the will is the legal document that you put in writing that says your wishes regarding the distribution of your property and the care of any minor children, right? So we want to decide who's taking care of our kids, not the state. We don't want our kids to have to go through foster care or anything like that. So we put that in writing. Then the living will, which is different from the will, is a type of advance directives. So you are specifying the medical treatments, procedures, medications that you do or don't want to receive. So, for example, if anything were to ever happen to you, a car accident, something, and you can't speak for yourself, your healthcare agent, doctors will consult this document for healthcare instructions, right? Now, this used to confuse me a lot, so I can imagine it confuses other people with the difference between the living will and the healthcare directive. So the healthcare directive isn't limited to like terminal illnesses, right? It can include things like dementia, stroke, or coma. So there are many different types of advance directives, but the one that we hear about the most and might ring a bell to a lot of you is that DNR, the do not resuscitate. So some people sign the DNR and say like, hey, no extraordinary measures. Don't keep me on, like if I flatline, don't bring me back. So that's the difference between the healthcare directive and the living. So I just kind of wanted to share with all of our listeners because it used to confuse me. I'm like, wait, they're both about medical things. So there is that little distinguished detail. Now, the power of attorney, that is the legal authorization for a designated person to make decisions about another person's property, finances, or business affairs. Powers of attorney are really important, especially even for like married, because if you are not an owner or not listed as an owner, you need to have one of these so that you can do things. Like once I had my car towed, and so I went to the towing company and I went to go pick it up, and the poor lady in front of me was having a screaming match with the people there because she was there to pick up her car. I mean, but it was in her husband's name. It wasn't and her. It was just her husband's name. She was like, but we're married. It's my car. I drive it. Here's my insurance. But it didn't matter. It had to be him going to pick it up. But unfortunately, he was either out of state, out of country. I don't know where he was. But anyways, he couldn't come in their timeline. And I don't know if you know this, but at tow companies, if you don't pick it up in a certain amount of time, they take control of it. So here's this lady screaming about her BMW that was about to be controlled and taken over by this tow company because she didn't have the power of attorney. Could you imagine losing your car because of a technicality like that? I mean, it's really important that we have all of our legal docs set up. Right. But I digress. To tell us about trust, what type of assets can we put into trust?
Okay, so I'm going to make this pretty quick because I want us to do a whole nother podcast on just trust, because plenty of stories that I just so people, I think stories are great because it helps people understand and see themselves in these different situations. Yeah. And the thing we can put in our trust is anything we own, our bank accounts, our homes, if we have rental real estate, we can put that in trust. There's so much that we can put into our trust. And have you ever heard the saying, the poor and the middle class, they want to own everything, and the wealthy own nothing?
Yeah, I have.
What does that mean? I mean, the reason why they say that is because when you own everything, if you get sued, they have lots to take from you. If you own nothing, and we know that there's a lot of wealthy people, they own a lot of things, but guess how they own them? They own them inside of a trust. That means if they're sued, it can't be taken away from them. So the trusts were created a long time ago to help people and protect people from losing their assets. And the one thing that cannot go into these trusts are qualified plans. But it's okay not to have them in your trust, because if you're being sued, they're actually protected from creditors. However, it doesn't protect you from medical. And we all know, I mean, how many people do you know that have had to file bankruptcy because of medical bills?
A lot.
Our medical bills, and this is another topic also that we can do for a podcast, because there are, if you have all of your assets inside of a trust, you do not have to spend down everything that you have to be able to qualify for medical assistance. We've paid into the government for a long time. And most of us have paid taxes, we've paid into the government. And yet, when it comes to our medical, and having Medicare and Medicaid, it's actually better to have Medicaid, because when it comes down to it, you're going to be taking, for example, my grandmother, she just passed away. Well, guess what? She has paid into the government for so many years, and she wasn't able to get the kind of medical help that we wanted without having to spend down her whole to be able to pay for her medical help. But Medicare that we all get once we turn 65, they will pay for hospice. They put her on hospice and she was gone. I mean, they're willing to pay for that. So there is so many ways that we can protect ourselves, and trust, the right type of trust, can not only protect you from probate, but it can also protect you from losing your assets.
Yeah, I think that we should definitely have maybe even a couple of different episodes, because there are so many things that we can talk about on this subject and different nuances that are so important for us to pick up on. So we'll definitely schedule that out, because, yeah, Chris, there's a lot of information that will benefit a lot of people from hearing about. So even with that said, I learned a lot today. Thank you, Chris. You always bring such great nuggets of information. You answer all of my questions and give great stories, because like you said, yeah, stories help people see themselves in any situation and kind of bring it down to a method or a way of seeing it in their own financial situations. So thank you. But quick question, did we answer all of your questions, listeners? As you were listening to us speak? Did you have something that popped up as a question, or even a question you've always had but we didn't get to? We do want to hear from you. What do you wish you knew more about? If you leave us a 5-star review on Apple Podcasts, ask in the review or send our Facebook page a message. We will add it to our episodes. We come up with topics that we think that you'll be interested in, but definitely if you put that you are interested in a topic, we will talk about it.
Sweet. Well, that wraps up this podcast for this week. Thank you so much for tuning in. Join our Facebook group. We have a new Facebook group. It's called CashFlow Hacks. Join us there. We'd love to see you, and we'd love to get your questions answered there too.
Yeah, and follow our Facebook page, CQ Consulting Services, Inc. as well, because we're always sharing tips and tricks on that page as well.
All right, everyone, have a great week, and we will be back next week. Talking about taxation, the biggest expense, the biggest thing the biggest wealth destroyer, really.
Yeah, it is. It is. See you next week, guys.